Most people think there's one secret to wealth they just haven't learned yet. They're looking for a single decision. This is a profound misunderstanding of the game. The financial divide between the comfortable and the truly wealthy is carved by a philosophical choice that has no easy answer. Smart, successful people land on opposite sides of this line, and both have compelling reasons for being there. Where do you stand? By the end of this, you might change your mind. The most common advice given to anyone hoping to build a secure future is to accumulate. Save aggressively, max out your retirement accounts, invest in low-cost, diversified index funds. Pay down your debt, especially your mortgage. The goal is a number, a net worth high enough to generate a safe withdrawal rate that covers your expenses for life. This is the gospel of financial independence. Its high priests preach the power of compound interest and the virtue of patience. Your home, once the mortgage is paid, becomes your fortress of solitude. A paid-off house is a psychological and financial anchor, a bedrock of security that no market swing can take from you. The logic is almost impossible to argue with. It's a system built on decades of market data. It works. For millions of people, this path has led to a life free from financial worry. It's a victory achieved through defense. You win by systematically eliminating threats, you cut expenses, you pay off liabilities. You build a diversified wall of assets so thick that no single failure can breach it. It's the slow, steady march to freedom. A marathon won one disciplined step at a time. The end result is a life of comfort, where you own your assets, and more importantly, you own your time. That sounds like the definition of success. But there's a problem with a fortress. While it keeps threats out, it also keeps you in. From the other side of the divide, this picture of success looks like a beautifully decorated cage. The philosophy of the truly wealthy is often built on a completely different foundation. It's about velocity, not accumulation. It's about cash flow, not net worth. To this way of thinking, a high net worth is a vanity metric. What matters is the monthly, quarterly, and annual income your assets generate. $1 million in an index fund is impressive, but a portfolio of assets that generates $10,000 of spendable cash flow every month, regardless of whether you work, is power. The paid-off house, the bedrock of the accumulator's world, is seen here as a sleeping asset, an enormous pile of capital tied up in a single non-performing investment. It produces no income. In fact, with taxes, insurance, and maintenance, it has negative cash flow. It's a liability disguised as an asset. The core strategy here is leverage, specifically using debt as a tool to acquire cash-flowing assets. The most common vehicle is real estate. An investor might put 20% down on a rental property. The bank provides the other 80%. The rent from the tenant pays the mortgage, the expenses, and hopefully leaves a profit. The investor has full control and receives all the cash flow from an asset they only paid for a fraction of. Repeat this process, and you're using the bank's money and the tenant's money to build a personal financial empire. The goal isn't just to get rich slowly through market appreciation. The goal is to get rich actively by acquiring systems that produce money. This is the world of business owners, of active investors, of people who see capital as a tool to be put to work aggressively. They aren't saving their way to wealth, they are building machines that create it. That sounds incredibly powerful, and it can be. But this approach to wealth completely and deliberately downplays the one factor that keeps most people on the safe path: catastrophic risk. Leverage is a double-edged sword. When it works, it magnifies gains spectacularly. When it fails, it magnifies losses with the exact same ruthless efficiency. The real estate investor, using debt to build a portfolio, is one bad tenant, one unexpected recession, or one interest rate spike away from ruin. A 20% drop in the market for the index fund investor is a paper loss. It's uncomfortable. A 20% drop in property value for the leveraged investor can be a wipeout event, a margin call, a series of forced sales that turns a paper empire into actual life-altering bankruptcy. This is why the accumulator's path is so seductive. It's a direct response to the fear of ruin. The 2008 financial crisis was a masterclass in the dark side of leverage. Millions of comfortable people with paid-off homes and diversified portfolios weathered the storm. Many people playing the high-leverage game were obliterated. They lost their businesses, their properties, their homes. The defensive strategy of the accumulator proved its worth. It prioritizes survival above all else. The first rule of winning, they would argue, is to stay in the game. And the surest way to get kicked out of the game is to borrow too much money and bet too heavily on a single outcome. The slow, steady path looks infinitely more appealing when you've seen the wreckage at the bottom of the cliff. And yet, is the safe path truly free from risk? Or does it just expose you to a different, quieter, more insidious kind of danger? The accumulator is playing defense against the sharp, sudden risk of a market crash. The wealth builder is playing offense against the slow, grinding risk of inflation and stagnation. For 40 years, the accumulator ties their fate to a single income stream, a job. They are trading their most valuable asset, their time, for a salary. They are completely dependent on an employer for their ability to build wealth. One layoff, one bout of illness, one industry disruption can derail the entire plan. They are outsourcing the control of their income. The safe portfolio of stocks and bonds has its own hidden vulnerabilities. It protects you from the risk of picking the wrong company. It offers no protection from the risk of a lost decade, a period of prolonged market stagnation, where your money goes nowhere. It offers little protection against inflation, the silent thief that erodes the purchasing power of your carefully accumulated nest egg every single year. A 3% inflation rate will cut the value of your money in half in just 24 years. Run that math across a 30-year retirement. The number that looks so big on the day you stopped working starts to look terrifyingly small. The fortress can become a prison. You have the money, but you're too afraid to spend it because you might outlive it. You achieve the number, but you miss the point. This isn't a simple debate between saving and investing. It's a fundamental conflict of financial philosophy. It's a choice about what kind of risk you are willing to accept. Are you more afraid of a sudden spectacular crash or the slow, silent erosion of your life's work? Are you more afraid of losing money or losing time and opportunity? One path prioritizes the preservation of capital. The other prioritizes the velocity of capital. The accumulator wants to build a pile of money so big it can never be spent. The builder wants to create streams of money so strong they can never be stopped. One is a static view of wealth, a noun. The other is a dynamic view, a verb. The truth, for most, lies in a messy middle ground, a hybrid approach, building a safe, defensive core of assets using the accumulator's logic, then using the smaller dedicated portion of capital to play offense, to start a side business, to invest in a rental property, to take a concentrated bet on a high-growth opportunity. This approach seeks to balance the need for security with the desire for something more. It acknowledges that the greatest risk might be taking no risk at all. It understands that true financial strength may come from having multiple, uncorrelated income streams. A job, a dividend portfolio, rental income, and a small business. If one leg gets cut out, the table still stands. Ultimately, the decision that separates these worlds is one of personal psychology. It's about your relationship with money, control, and fear. Are you building a system to protect you from the world? Or are you building a system to engage with the world on your own terms? Is money a shield, or is it a tool? The person who builds a $10 million net worth through index funds and the person who builds a $10 million real estate empire live in different financial universes. They have different problems, different anxieties, and different freedoms. Neither path is inherently superior. Both require immense discipline and focus, but they lead to vastly different lives. So, the question is, what game are you actually playing? Are you focused on building an untouchable net worth, a fortress of security to see you through retirement? Or are you focused on generating active cash flow, using leverage and enterprise to build an income machine that works for you? There is no universally correct answer. There is only the answer that is correct for you. Where do you draw the line between security and opportunity? What does wealth actually mean? Is it a number in an account, or is it a steady stream of income hitting your bank statement every single month?